Hello and welcome. This is another in the 10-minute tips series of programs for credit and collection professionals. This program is titled Setting Credit Limits. My name is Michael Dennis. I'll be your presenter today. Let's begin with an introduction. I think it's fair to say that setting credit limits for your customers is part art and it is part science. Unfortunately, there's no best way to establish credit limits for customers. However, if you are in a position where you can establish appropriate credit limits for your customers, it's going to make your job a lot easier, especially the job of collecting past due balances. In other words, if you set credit limits appropriately, then you will have less difficulty collecting past due balances and you will have lesser, smaller, fewer bad debt write-offs. With this in mind, credit limits that you have established for customers need to be reviewed regularly. And in addition to being reviewed, they need to be increased and/or decreased as conditions change in your organization, and especially as conditions change within the debtor company's organizations. Basically, credit limits that you set for your customers need to be set low enough to adequately manage the risk of either non-payment or slow payment. How creditors set credit limits. Ideally, you're in a position in which credit limits in your company are established based on some form of comprehensive analysis of facts and factors that are important to the credit decision, including but not limited to a review of customer financial statements, along with a review of bank and trade references, as well as obtaining and reviewing updated credit reports as well as trade clearance reports. Now notice this says it includes a review. There are other facts and factors that can be included in the process of evaluating the risks associated with doing business on open account terms, and then setting a credit limit that is appropriate to that level of risk. Some creditor companies to this day establish their credit limits by doing what I refer to simply as follow the leader. What they do when it comes to setting credit limits is they obtain a credit report or they pull a trade clearance report, perhaps a trade clearance report from their industry credit group. They look at that credit report, they determine a high credit based on the amount of credit that other creditor companies are extending to that particular customer or to that particular applicant company. Thus, they are following the leader as it relates to credit limits. Other creditor companies today use some type of formula to establish credit limits for existing customers as well as for new accounts. For example, they may use a formula such as this. The credit limit that we establish is a percent of the customer's net worth. So I've seen a number like this. The company may say, our credit limit is 5% of the customer's stated net worth or 10% of the customer's tangible net worth. Alternatively, another formula might be to say we will establish a credit limit which is a percent of the applicant company's net income for the last fiscal year. So it might say, as an example, we'll look at their income statement, we'll determine how profitable they are, and the credit limit that we set for this customer will be 25% of that particular company's net income for the prior year. So just a quick comment on the idea of using percentages. The dilemma, the problem, the concern I have about a formula-based credit limit is the justification for the decision. The math is easy. It's 10% of this, it's 5% of that, it's 25% of the other thing. But the question that remains open is why that percentage, why that multiplier is relevant to how much credit the customer is owed, is entitled to. And so the dilemma is it's just a formula without any basis in fact as to why that particular multiplier, that 10%, that 5%, or that 25% using the examples, is the right number to multiply in order to establish an appropriate credit limit. Let's continue our discussion about how creditor companies set credit limits. Some creditor companies offer what's referred to as an accommodation credit limit. What this basically means is that any applicant company that requests open account terms is given some amount of open account credit. It could be a very nominal amount like $1,000 or $5,000 or even $100. The concept here is that we're planting a seed and we're hoping as a creditor company that the applicant company will grow with us. And as they demonstrate their ability to pay invoices as they come due, this relatively small opening initial credit limit, the accommodation credit limit, will grow. Some creditor companies base the credit limits on some type of credit scoring software. Now, the good news is that there is commercially available credit scoring software, and it's fairly sophisticated. This, by the way, the software is a mature product. Credit scoring software for commercial credit grantors has been around for at least 30 years, so it's a very mature product. It's feature-rich, it's intuitive, it's easy to use, it's inexpensive. And the real good news about credit scoring software is that it offers real insights about the risk of doing business either with new accounts, by which I mean applicant companies, or with existing customers. So some creditor companies base their decisions about how much credit to extend to a customer or to an applicant company on the credit score that is generated by the credit scoring software that they purchase and use. Other creditor companies today base their credit limits on the customer's credit needs. What that means is basically if the customer says, I need a $10,000 credit limit, they get a $10,000 credit limit. What these creditor companies are doing in a very real sense is assuming that their collection efforts will be sufficient to collect any balance that becomes past due. This is sometimes referred to as ship and pray. We're going to ship whatever the customer needs in the form of open account shipments, and then we're going to hope and pray that we can collect the past due balance if and when the account becomes past due. Some creditor companies base their credit limits on an applicant company's payment history. What they do is they'll obtain a credit report or a trade clearance report, and they'll look to see what it tells them about how this particular applicant company pays other creditors. So basically, if the applicant company pays other companies on time, that particular creditor is likely to approve the credit limit requested by the applicant. And if the credit report or the trade clearance report indicates a number of issues with slow payment, then the creditor company is less likely to approve the requested credit limit. It's also true that some creditors evaluate only the customer's financial condition. What those companies will do is they'll request from the applicant or the customer a balance sheet, an income statement, and a statement of cash flows. They'll perform some type of financial analysis. They'll do some ratio analysis. They will consider all the facts and factors in connection with the applicant or customer's financial condition, and then they will make a decision based only on financial condition about what credit limit is appropriate to that particular customer or that particular applicant company. Other credit managers actually use consumer credit reports, often in connection with companies or applicants that are partnerships or proprietorships. So these creditors focus more on the consumer credit history of the applicant company's owners, as in the partners in a partnership or the proprietor in a proprietorship. Other factors to consider. So other factors to consider when you're setting credit limits for a customer or an applicant include, but are not limited to, obviously, whether or not your company has credit insurance, and if you have credit insurance, how much coverage you have for that particular customer or that particular applicant company. How the customer or applicant pays other creditors today, or how they have paid other creditors in the past. The applicant company's credit score, either from sourced from the credit reporting software that you've purchased and use, Or another source of credit scores are third-party scoring entities. So there are companies that will provide you with a credit score without you actually having to utilize and purchase the software, but it's not necessarily a cost saving, it's just a different way of obtaining credit scores. And another factor to consider is whether or not your company has any credit enhancement, such as, for example, a personal guarantee or an intercorporate guarantee or a letter of credit or a standby letter of credit or a lien or an encumbrance. A better methodology. I would encourage you to please consider a variety of facts and factors when you're trying to set the appropriate credit limit for a customer, including but not limited to these: bank references, trade references, customer financial statement analysis, one or more credit reports, such as a D&B report as well as a trade clearance report, an evaluation of your company's risk tolerance, your tolerance for either payment delays or payment default. Another factor to consider is your company's bad debt reserve, and another is your department's recent credit loss history, the loss history you might have had in the last 12 months as an example. Another is whether or not you have any collateral or lien rights involving this particular customer, whether you have or are considering purchasing credit insurance, and whether or not you have any guarantees involving this particular customer or applicant. In addition, factors to consider would include your company's overall profit margin. How profitable is your company in total? Whether or not you can arrange to become a secured creditor on sales to this specific customer. In addition, your company's payment terms. And not surprisingly, the longer the terms that you offer to customers, the higher the risk to your company. That particular customer's payment performance involving other creditors, in particular your competitors. What you don't want to inherit in the form of a new account is one of your competitors' problems. So it's important to know how that particular customer or that particular applicant now coming to you for open account terms has been doing in terms of paying your competitors. Because again, you don't want to inherit somebody else's slow payment problem. In addition, the better methodology would involve evaluating any of the risk flags that you see, including but not limited to negative equity as shown in the balance sheet, a previous bankruptcy as revealed in a credit report, low equity, tax liens, and lawsuits. And again, these are just examples of risk flags that you may note in connection with an applicant or a customer. I want to thank you for your time and attention today. I hope you found this presentation to be interesting. If you're interested in hearing the entire 1-hour presentation on this specific topic of setting credit limits, please contact the Sponsoring Credit Association for more information. And again, have a great day.